The Nifty and the Sensex scale new peaks on most days this week, but snapped their winning streak on Friday. However, for the week, the markets ended in the green. On this week's Editors Roundtable, we discuss if investors should be cautious despite the record tumbling on Dalal Street. Are the new age companies close to bottoming out? And we also take a deep dive into the house of Tatas. I'm Reema Tendulkar. With me is Prashant, Nimesh and Nigel. Hi, guys.
Hi, Reema. I mean,
what a week, right?
When the markets made new all-time highs, all of us were complaining that we're not feeling like it's all-time highs. Yeah. But I think as we came to the end of the week, we're feeling it, right? Because broader markets are starting to participate. Mid-caps and small caps are doing well. And I think the participation is what causes the excitement.
Yeah, and a year-long period of consolidation, right? It took the Nifty 400 days to get back to its all-time high levels. So we've spent a long period consolidating.
But even then, we've outperformed, right? I mean, look at the global markets, look at the other Asian peers. We're relatively outperforming the markets for all of this year. Yeah. So, actually, I was just looking at some 2023 reports, which maybe I'll highlight next week. We're starting on a very firm footing, and the valuations are very, very rich. So 23 is going to be quite challenging, at least in the first half. That's the overall feedback. So I guess that's one thing we have to keep in mind. Right now, everybody is enjoying. There is party mode. People are going to travel to watch matches for the next 2 weeks for the World
football
Cup.
Fever,
all
right?
The football fever is going to be at a peak for the next 2 weeks, right? The private equity guys, the corporates are all flying off, is what I understand, for the next 2 weeks. So the volumes are going to be quite low, and we are the only guys who are going to sulk and work all of December, just looking for dealing rooms and flows, and that's it. So
in terms of the markets, Friday phenomena seems to be supporting the broader markets, right? On a Friday, we see that the small cap and the mid cap index, they do pretty well. Last Friday, this Friday as well, just taking these 2 Fridays. And just one more point, you'll say Friday we ended with a cut of around 100 points. For me, that was the best session. The breadth of the market was phenomenal. Yeah. With the Nifty down 100 points, the larger cap stocks didn't do well. But you felt like we were at around 18,500. A lot of stocks were flying away. Some of those stocks that went up, they could be circumspect. Some of them could be one of those big losers that did bounce back. But I was happy at the end of the week to see the smaller and the mid-cap names. They're coming to the party, right? It's
and the way the alcohol stocks are buzzing in the buzzing. It looks like you're having a party. Exactly.
It's cheers all the way.
Exactly.
I'll take the bill, guys, but I'm sure y'all are sneaking in there as well. Prashant is trying to act all cool. I'm sure he's docking it in both of me.
Every weekend we've got something to watch, right? The next 3 is going to be all about the football match.
Yeah.
That's the only time you can stay up at 12:30
just one more thing. There is state election results also, yes. This coming week. On the 8th, I think that's Thursday, right? We get election results from Gujarat and Himachal.
Yeah. And before that, RBI MPC?
RBI MPC. I mean, there are actually other events apart from football. There are a few other things lined up as well. But Nimesh, what are you picking up? Dealing rooms?
So, Prashant, we all know that this was a week when we had record highs. So that was a bit of a cheer for the markets. The good part is, as you rightly pointed out, towards the end of the week, we saw a bit of participation back from the mid caps and small caps. So the broader indices have started to perform. So that's a good sign. But the big takeaway for me was the fact that so much of supply is getting absorbed, right? Look at this week, PB Fintech, 5% equity got sold, and today the stock ended 5% higher. The block happened in the block window, which means there was no discount. There was firm buyers as well. Look at even Zomato. There was a 3% block. Alibaba sold 3%, and after that the stock is up 4-5%. So clearly, that shows the kind of strength which is there for the Indian markets. The big supply is getting absorbed. So that's something which has been a heartening point. As we rightly pointed out, finally we are seeing a bit of catch up in the mid cap and small cap. It's trying to outperform now and catching up with the Nifty as well, which has been an outperformer of 2023. I guess, if you look at this week, what sectors participated and did well. Metals, largely a hope of China opening up trade. So that played very well in the metal names. If you look at real estate, despite, high interest rates, you've seen a bit of the kind of November data which show up in the stamp duty registrations. That shows that the momentum is clearly there in the real estate. And the big takeaway for me was the sector was IT. Technology stocks, from a flow point of view or from a positioning point of view, what I understand is there was short covering. But now larger funds are looking to rebalance and come at least equal weight. They were underweight, and now they're turning to turn equal weight. In fact, a couple of large names have bought names like Persistent and the mid-cap stocks in this week. So that was a big taking point for me, that there is participation from metals, IT, and those have done well. So broadly, I guess we are heading towards. We are already at all-time highs. Maybe this is a time when for the next 4 weeks you will see a big outperformance in mid-cap and small cap. So the party may be there. in the mid-cap and small cap. So that's something to watch out.
You know, Nimesh, just a point on the real estate stocks. We had DLF, we had Prestige,
Yeah.
as well as
Macro-tech
Macrotech.
developers.
And they are saying that demand is rock solid.
Exactly.
You know, and the stocks have reacted as well pretty favorably. So that was another big cue. I mean, they're talking about interest rates moving up, but they're saying till now demand is fine. Things are looking up. So that's pretty good news. But Prashant, you're at the other spectrum.
New age stocks,
New
right?
age stocks.
Not brick and mortar, but
Yeah.
digital platform stocks. And actually, that has been a theme this week as well, as Nimesh pointed out. Lots of supply is coming, but it's getting absorbed. So, you know, I'm going to go across to the big wall and tell you. Actually, it's just a question. I don't know if this provides answers, but I think it's important to ask the question as well. This is the question: have new economy stocks fallen enough? Right now, let's just assess the damage first. And I think this is pretty simple, straightforward. This is the listed universe of new economy stocks, market cap at all-time highs, and the current market cap. The damage is clear, anything between 50 and 70, 75%. Top of the list, of course, is Paytm, followed by Policy Bazaar. Car trade, of course, very small. Nykaa, which is also now at all-time, almost at all-time lows. Zomato, delivery, etc. as well. You know, the next number is what is actually even more, it's stunning and sobering at the same time. This is what these two companies, specifically, Paytm, in its private life raised. They raised $4 billion as a private company before they came to the market. And the market cap after this week's rebound has only come back to $4.2 billion. That is stunning, right? You've raised equity capital of $4 billion, and now after listing, the entire listing process, after a year of being listed, the market cap is basically $4 billion. Car trade, of course, much smaller entity, raised 350, and now it's about 280. Paytm's plunge actually is at a bit of a record as well. You know, these are some of the global companies. The cutoff is 1 year after listing. It ranks as one of the top 4. But it's not just the listed space where we've seen large valuation cuts. You heard how one of the large investors in Byju's wrote down the value of their investment in Byju's. The peak was 22. They say the total company, according to their markdown, is worth $6 billion. That's sharp, right? That's the poster boy. And there are other companies, some very well known, some not so much, but Shop Clues, Practo, Quicker, etc. And you can see the erosion. And by the way, you talk to experts, the general feedback is more markdowns will happen. There is all the incentive in the world for founders and early investors not to do a down round, basically raise money at a lower valuation than the previous round. But if conditions don't change, they'll have to do that as we get into next year. Now, I'll come to the last and the most important bit. What I've done is I've taken EV by sales. EV by EBITDA is not possible for many of these because the EBITDA is, many of these companies don't make an EBITDA. And this is 1 year forward. Listed companies here versus global peers. So look at Paytm, and in the case of Paytm, because they do so many things, I've taken a variety of companies, some in the payment space, some in BNPL, some in the overall fintech ecosystem, and you can see how valuations have come off. Now, it's not the case that others have not fallen. Others have also fallen. But the point is, starting valuations, when these companies listed, and if you looked at valuations then compared to global peers, the gap was very wide. And in some of these cases, the gap is narrowed. Look at Nykaa. Nykaa, of course, is still the most expensive. There is Ulta Beauty, there is Bath and Body Works. Zomato up on your screen, again, 6 times. You look at DoorDash, which is in the US, Deliveroo in the UK, and Meituan, which is the Chinese company, much cheaper, much cheaper. Again, this is just the valuations. We're not looking at delivery, for example. You could argue and say they're asset light. Many of these other companies are asset heavy. There are differences in business model, and it's not possible to go into all of them, but this is the valuation. Let's just go back to delivery once. Delivery is interesting because I think it's also delivery is at about, 2.3 times. You look at YTO, SF Holdings, 2 Chinese and 2 US companies. Again, they've come off quite a bit. The last is PB Fintech, which will come up on your screen. 6.2 times, and the big one I could find was Goosehead Insurance, which is now at about 5.9 times EV by sales. So again, as I said, this is not a clear-cut answer whether companies have fallen, stocks have fallen enough and they'll do very well from here straight up. But this gives you a sense that valuations in many of these cases are not so out of whack compared to where some of these global peers are trading at this point in time. Perhaps, just perhaps, for some of them, you started the process of some sort of bottom formation. So that's my piece. But Nimesh, that's exactly the point, right? This week, you've basically seen a lot of supply getting absorbed, And in classic market reaction function, stocks are starting to move up, inch up slowly but surely. What are you picking up?
Yeah, so that's right, Prashant. Exactly what I said 2 weeks back as well, that for this, platform companies, you have to look for, the performance, the fundamentals versus the technical overhang. And that's exactly what is played out. If you look at, say, I've just looked at the 4-5 platform companies and who all have sold since the lock-in opening up. So look at PB Fintech. Yesterday, there was a large block, 5% equity changing hands today morning. So SoftBank has sold, Tiger Global has sold. Nearly 12% equity has changed hands since the lockup opening up on November 11th. And since then, the stock is up 30%, more than 25-27%. If you include today's move, it's up 30-odd%. So that's the kind of move you've seen despite a 12% block happening in PB Fintech. Look at Nykaa. The lock-in opened up on 10th of November. Since then, 7% equity of Nykaa has changed hands as well. And the likes of Lighthouse, TPG, all have sold out. And even then, the stock is virtually flat. It's not given negative returns, but it's actually flat. Look at even Paytm. The lockup opened on 15th of November. Since then, even in Paytm, nearly 8% equity has changed hands, and the likes of SoftBank and all have sold a large chunk. And after what you have seen, if you include today's move, 5%, the stock is down just 10-12%. So even Paytm has recovered sharply from the recent lows. Even if you look at delivery, even there, Carlyle sold 2% equity after the lockup opening up, and even that stock is flat. So again, the bottom line is, while there has been a lot of supply in all these platform companies, but that's getting easily absorbed, and the stocks have started giving positive returns. So again, the whole point is, to put out this data was, you have to look at fundamentals as well. And fundamentally, a lot of companies have started talking about, improving their margins, improving their operational efficiency, and that's why you're seeing a bit of interest back from domestic and some HNI investors in this platform company. So that's about platform companies. But I'm going to ask Rima. The big talking point or the big news of this week was the Tata Group looking to merge all the airline businesses. They've done it in steel as well. I guess you put out a nice piece on what to expect more from the Tata Group, Rima.
Absolutely. So the big talking point this week was the merger of Vistara as well as Air India, and consolidation and reorganization has been the big theme for the Tata Group under Chandra. So here we're not trying to speculate. All we're trying to do is identify the multiple listed, unlisted, independent subsidiaries that the Tata Group have, which sort of fish in the same waters. Where is it possibly that the Tata Group could look next to reorganize and consolidate its business? The words that I'm using are simplify and scale, and that's really been the mantra of the Tata Group under Chandra. As Nimesh pointed out, it started with the consumer business. Then earlier this year, we had the steel business where 6 subsidiaries got merged with Tata Steel. And then this week, it was in the aviation business. Where next? Let's start first with the retail business. What is it that the company has in their retail assets? Well, they have Tata Digital, which owns 1MG and Big Basket. That's the e-commerce business. They also own Infinity Retail, which owns Chroma. They have Trent, the owner of Westside, Zudio, Zara. And then you've got Titan, jewelry, watches, eyewear, etc. Right? You would think at first glance that these are all independent entities. But if you delve deeper into these companies, you would see that the lines of their business are merging. For instance, Trent also has a supermarket tie-up with Tesco. So they're not just into the apparel space. Take a look at another business, right? Titan. It's not just jewelry, eyewear, and watches. They have a fledgling sari business which comes under the brand name of Taneira. So if you want, you can really try and find some synergies. Next, let's talk about the hospitality space. Here, the Tata Group has 3 listed entities. The big one, of course, is Indian Hotels, but they also have a 25.5% stake in Taj GVK, which is a JV between the Taj Group and the Reddy's, and they also have a near 28% stake in Oriental Hotels. In the technology space, the crown jewel for the Tata Group has been TCS. But they've also got Tata Elxsi, which is an ER&D play, specially catering to the auto and the media space. And you've got a Tata Tech, which provides technology to Tata Motors. So if you want, you can really find synergies because Tata Tech also provides to the auto sector, and so does Tata Elxsi. In the telecom business, they have a Tata Communication, which basically provides connectivity solutions to large enterprises. But they also have a Tata Tele Business Services, which is unlisted, but that provides connectivity solutions to the smaller companies, the SMEs. So in that sense, there is that synergy. Apart from that, they also have Tejas Networks, but that's largely a hardware business. Now let's come into auto space. Here, the company has 3 listed entities: Automobile Corp of Goa, Automotive Stamping and Assembly. These are small companies with a market capitalization of only 600 crore. In terms of revenues, the annual revenues would be 200-250 crore. But 3 listed entities. And finally, in the chemical and fertilizer space, you've got Tata Chemicals as well as Rallies. We're not trying to speculate what the Tata Group is going to do, but all we're saying is that history tells us that under the Chandra Group, the Tatas are looking to simplify and scale up their business or consolidate, reorganize, and there are multiple companies, independent, listed, unlisted, which sort of fish in the same water. So with that, I'm going to wrap up my piece. We're going to slip into a very short break. On the other side, we'll invite Ashwini Agarwal of Demeter's advisors.
Earlier this week, we were joined by Pankaj Tibrewal, and he made some very, very valid points with regard to the earnings picture. So I said, let's take that forward. Keep in mind that we're getting into a weekend, so you need to party. But when you're getting a little bit high, then it's a reason to be cautious, right? Similarly with the Nifty, at these high or elevated levels, there is reason to be a little bit cautious as well. Well, the MSCI India Index has outperformed the MSCI World Index by a large margin. And the gap out there is widening. And India is not cheap. 22 times on a PE basis, on a market cap to GDP basis as well, we're not cheap. And earnings have been pulled back by only around 5%. Now, looking at the earnings picture, you'll see that the Nifty 50 earnings picture looked pretty good. But if you look at the NSE 500 companies, a third of those companies, they delivered an earnings degrowth. The NSE 500 companies' earnings, in fact, the degrowth was close to around 3%. And stripped of the BSFI companies, well, the degrowth was more than 25%. Now, on the top line, things look good. Close to around 44% of those companies, well, they delivered their best ever revenues in a quarter. However, the number of companies that delivered their best ever EBITDA or operating profit in the quarter was only around half of that. Only around 22% of them did deliver their best ever operating profit, telling you that the top line growth didn't really translate into operating profit growth. Moving to the cash flows then, well, there is a clear sense of deterioration out there for the BSE 500 private companies. And that's because, you have the working capital that's seen some bit of deterioration. We're looking at the deterioration close to around 60% of the BSE 200 companies. Well, they did see some bit of a deterioration. And the problem is, with this sort of a deterioration, will it have an impact on capex? That's a question mark. So for the time being, enjoy the party, but at these elevated levels, well, some bit of caution on the earnings front is warranted.
All right, that's very interesting, Nigel. Thanks very much for that. Let's put this to Ashwini Agarwal, who's now joining us right here. Ashwini, it's always a pleasure. Great to see you.
Thank you.
Again
Thank
on
you
the
for
program.
having me here.
I mean, some points on overall corporate profitability and how it's been a mixed kind of a picture.
Yeah.
What's your sense, and how would you look at this?
So, you have to actually get a bit deeper into the weeds, because what's happened is that there have been a lot of cost pressures on account of raw materials, on account of energy, on account of transportation, and some of these cost pressures are visible in the earnings that you've seen over the last 2 quarters, but some of these places you will see an improvement in margins going ahead, because some of the high cost inventory of raw material has been now exhausted. Some of the supply constraints have gone away. Transportation costs globally have started to come off. So some of these benefits will start to come through. Of course, what you will also see is some of the export demand fading away. That will happen. But on the whole, when you look at the aggregate numbers, they hide as much as they reveal. So I would actually go a little bit deeper and say that situation may not be as bleak as some of the aggregate numbers suggest.
Ashwini, you made a very interesting point in the break that you're not too overly cautious on the market.
Yeah.
And like lever in the last 10 years, India's multiple will keep re-rating.
That's right.
Can you just take it, just to explain our viewers, what do you mean by that and how you think the markets are going to be in 23?
So I have this philosophy that in markets, whatever is in scarce supply goes up, right? Over the last 12 years, quality was in scarce supply, growth was in scarce supply. So the multiples for these 2 factors just went through the roof. In a global context, India is now in a situation that it's one of the few areas where there is no macroeconomic imbalance, there is growth coming through. So the relative outperformance of India is explained by that. And in that sense, to look at valuations alone, maybe making the same mistake that people like us did as value investors by ignoring levers about 5 or 7 years ago, and the valuation kept expanding and we kept thinking why. And that might come through for India as well, unless some macroeconomic accident happens to us or energy prices again go through the roof. So, I'm assuming that macroeconomics for India will continue to remain stable, and if they do, then I think valuations is something that investors will choose
Although
to
there is
ignore.
one small difference. Last 5-6 years, interest rates, the risk-free rate of the world, the US 10-year was 0% or zero bound.
Right.
It is 5%,
Right.
or closer to 5% now, right? And it's not going to go back to zero
Correct.
in the next at least 2 years. I mean, we don't know. But so, I mean, should we expect the same kind of valuation re-rating that you're talking about with regards to HUL?
So you have a great point. So you can't obviously expect that level of valuation re-rating, and interest rates will continue to go up from here by at least another 100 basis points over the next couple of quarters, both in India and in the US, is the general consensus that one hears. But at the same time, what I'm trying to say is that focusing only on aggregate valuations may be a mistake, because those aggregate valuations again have disparities within them. So I'm saying that India is in a great place. There are plenty of good bottom-up stories out there. There are one-off earnings pressures which might go away over the next couple of quarters. So I wouldn't be too bearish. Yes, a correction is possible. Markets look expensive. Individual stocks may be looking expensive. It's like this. Over the years, I've started to see valuations in the context of history.
Yeah.
So if you look at valuations in context of history, they're expensive at an aggregate level. But individual sectors are not expensive, individual stocks are not expensive, and that's the only caution I would provide to an overly bearish view.
Yeah, and Ashwini, a very valid point. I mean, to justify India's move, we have had billions of dollars of sale from the FIs, and yet we have stood our ground. Not
Correct.
just that, I mean, we have a stable government now, and crude oil prices have cooled off as well. So those factors are moving in our favor. My question to you is, earlier in the show, we were discussing about these new age themes.
That's right.
A lot of supply coming in there. November rain. It rained, but it got absorbed as well.
Absolutely.
What's your sense on these new age themes? Are they coming to some level where they'll generate interest, or do you believe there is still some pain ahead?
So very difficult to say. As you said, that valuations are now in the ballpark of being interesting. Okay, now whether you see another 20% drawdown or 30% drawdown, nobody can say.
Yeah.
Okay, that's impossible to say. But last year, towards the end of last year, at least when we were looking at some of these companies, we had no idea where the valuations were coming from, and we kind of stayed away from investing in any of them. And now I am looking at them. Have I invested in any of them? The answer is no. But am I looking at them? The answer is yes. I'm looking at them. They're looking very interesting. I don't know where the bottom is, but they're looking very interesting.
You want to give us a hint? Which side are you drifting among those five, six names?
I'm not allowed to speak about stocks.
All right.
All right, Ashwini, great conversation.
Thank
It's
you so
short,
much.
but we look forward to seeing you more in
Thank you.
person. Thank you very much and enjoy your weekend.
Thank
Well, guys, with that, it's a wrap on this edition of Editors Roundtable from the entire team. Thank you for watching, but don't go anywhere. On the other side of the break, more news and updates will follow.